Hello and welcome to my morning note. Is it a question of Carney to the rescue? This week we had the final of many inflation reports from Sir Mervyn King, the outgoing Governor of the Bank of England. Now the question is whether his successor, Mark Carney, can administer the same kind of shock to the system that Mr. Kuroda has done at the Bank of Japan. Now the argument of my guest today is that that's probably not going to be possible, but that a strategy that's more modelled on what the Federal Reserve is currently up to might indeed work. He's one of our principal economic bloggers and also the chairman of Fulcrum Asset Management, Gavyn Davies. Gavyn, thank you very much for coming on once more. Let's start by taking a look at a chart of Japanese government bond yields. You can certainly see the Kuroda effect in full force there. What lies behind that, and why isn't it possible in the UK?
I think the key when Mr. Kuroda took over a couple of months back was that he took over after many years of deflation in Japan, and many years in which the Bank of Japan had completely denied they would ever do anything like he has done.
Utterly reflected in JGB yields.
So he had a big opportunity to surprise the markets and to put the rate of inflation much higher. The issue, I guess, at the moment is this uptick in the JGB yield worrying. I would say it's getting a little worrying because it suggests that the inflation expectations, which have raised elsewhere, are now beginning to leak into the JGB market, which isn't great, actually.
So there are even some limitations on what the BOJ is doing.
Yes, but a lot less than Mark Carney will face, I think.
Now let's take a look at what you're suggesting for Mr. Carney. Let's start with unemployment. Now, plainly what the Fed has been talking about for the last few months is continuing with asset purchases until they can reach a certain level of unemployment. How does that work in a British context? Is that what you're suggesting for Mr. Carney?
The Fed did this in December, and I think we have to admit it has really worked.
Yeah.
The Treasury has asked the bank to look specifically at this, so we know they are examining this carefully, and Mark Carney has said good things about it. So what they would do is say, we will keep interest rates at a very low level, and maybe we will continue quantitative easing until unemployment goes to a certain level. UK, it's tricky because you'd like to pick the natural rate of unemployment where inflation is stable.
Right.
But in the UK, we don't exactly know what that is.
Well, and it's moved around rather drastically.
And it's moved around rather drastically. So here I've suggested it is about 6.5%, the sort of natural rate. You can't really safely go below that. He'd set a limit of, let's say, 7. So he'd say, I'm going to stay easy until unemployment is down to 7 from the current 7.8%. Right. And he wants to give a clear signal not just to the markets, John, but also to everybody in the economy. And that's why I think he'll pick something readily visible and understandable like unemployment.
Okay, now that makes a lot of sense. But if we now take a look at inflation, the classic Phillips curve trade-off might be hard to achieve because you could certainly argue that he's inheriting a situation where that inflation target has lost credibility. We've not really seen the inflation target of 2% in many years now.
Well, this is the real problem with this approach to life, where you give a pre-commitment of forward guidance to keep monetary policy easy. What happens if inflation comes in well above target? What the Fed has done is it's picked a threshold a bit higher than target and said, if we ever forecast above that, then we'll stop, we'll tighten. In the UK context, this graph shows it's a bit trickier because if you pick a threshold of 2.5% above the 2% target, we've missed that for 5 successive years with almost no break, and we're still missing it. But I think and this will be contentious on the MPC, I think, but he could pick a threshold of 2.5, say my long-term target is still 2, but I'm going to show some flexibility, and I will only stop easing if the inflation rate I forecast goes above 2.5. So it gives them a little bit more wiggle room, which we know is what he wants to have.
And it looks at the moment as though the inflation projections are trending downwards rather than upwards, which might give him some of that wiggle room.
He would currently be able to say this threshold is met because the 2-year forward forecast for CPI inflation is only 2%. So he could say this is met. Whether the markets would find this credible, I'm a little worried about, and I think that's the Achilles heel in this strategy, really.
Okay, Gavyn, thank you very much indeed. It sounds like a very sensible set of marching orders for the new governor to me. We'll have to see. Sterling took a dive, has started to recover. It'll be very interesting, particularly in the sterling market, to see how people gauge the new governor once he starts unveiling his policy.